Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Tesla, ticker TSLA.
Yeah, and there's a lot to dive into.
There is. Our mission here is to really analyze the strategic conflict raging inside its investment thesis, a battle we're calling the Great Divergence.
That phrase, the Great Divergence, it really defines the entire company right now. I think you can sum it all up in two sentences.
Okay, let's hear it.
So Tesla is executing a high-risk AI infrastructure strategy. It's leveraging this massive $41.6 billion cash fortress to pivot from just being a hardware manufacturer to a high-margin robotics and software monopoly.
But there's a catch.
There's a big catch. This whole thesis is currently obscured by, one, a significant safety validation gap, and two, the near-term margin compression you're seeing as legacy auto just retreats from the EV sector.
Okay, let's unpack that immediately, because you're right. By late 2025, the auto world it's fractured. It's split into two completely incompatible directions.
Completely. On one side, you have the legacy automakers.
We're talking Ford, GM, Stellantis.
Exactly. And they are executing a massive, a full-on defensive retreat. They're pivoting back to hybrids. They're cutting costs everywhere, just trying to preserve cash flow.
And then there's Tesla.
And then there's Tesla, who seems to be operating in a totally different universe. They're making an all-in bet, a huge capital commitment to artificial intelligence, to robotics, to, full unsupervised autonomy.
So their pivot isn't just about making better cars.
Not at all. It's about total transformation. They're aiming to go from being a vehicle manufacturer into what they seem to fully intend to be an AI infrastructure monopolist.
Okay, AI infrastructure monopolist. That's a very powerful phrase, but it also sounds a bit vague. If we're defining the risk, what is that infrastructure? How do they get a monopoly, not just, market share?
It really comes down to three things:
Yeah.
the silicon, the data, and the network. The monopoly isn't about the car itself. It's about owning the entire AI stack you need for autonomy.
The whole ecosystem.
The whole closed-loop system. The custom chips, which we'll get into. The exclusive real-world driving data from millions of cars. No one else has that.
Yeah.
And then the distributed network to run AI models on that data cheaply and globally.
So the car is just the hardware container. It's the Trojan horse, as some people are calling it, for the AI platform.
That's the idea. And the linchpin for this whole thing is their next-gen hardware, the AI5 chip.
Right. What kind of technical leap are we really talking about here? Is it just an incremental update?
Oh no, it's a radical optimization. The design philosophy is what they're calling radical simplicity. They've engineered it solely for their neural net approach, which is almost all video processing.
Which means they can strip out parts other chips need.
Exactly. They just deleted legacy components. They got rid of the traditional GPU, which is expensive and a power hog, and the image signal processor, the ISP.
And that's how they get this supposed 10x to 40x performance leap. That's unprecedented in a single hardware generation.
It is. And deleting those components gives them a massive advantage in manufacturing.
How so?
The design is so streamlined, it fits on what's called a half reticle. Now, for anyone who doesn't follow chip making, just think of a reticle as the stencil used to print circuits on silicon.
So half reticle means?
It means they can get two chips on one standard printing plate. It drastically cuts the cost per chip and boosts the yield from every wafer. They're maximizing what they call intelligence density.
That kind of cost cutting just changes the entire financial game. Let's talk efficiency, because that's what justifies them sitting on that $41.6 billion war chest.
The numbers are staggering. Musk projects AI5 will give them 2 to 3 times better performance per watt.
So less heat uses less energy in the car.
Right. But the crucial part is a dramatic 10-fold better performance per dollar compared to the alternatives. That 10x per dollar. That is the core idea justifying the valuation.
Why is that tenfold cost reduction so revolutionary, though? How does it change the math for their Robotaxi network compared to, say, a Waymo?
It fundamentally changes the margin profile. For every dollar Waymo has to spend on a high-end commercial GPU, Tesla can theoretically get the same performance for 10 cents. It lets them execute what they call the oversupply strategy.
Meaning they plan to make way more AI5 chips than they actually need for new cars. But isn't that a huge risk? What if the Robotaxi thing doesn't pan out?
And that's where the strategy gets really clever. They're using both Samsung and TSMC for production to guarantee this excess supply. The goal isn't just to sell cars, it's to turn all the idle cars, cars sitting in driveways or parking lots, into a global supercomputer.
So my car, when it's parked, becomes a node in a network. How does that even work, and how does it make money if it's not driving anywhere?
Precisely. Instead of paying Amazon Web Services or Google Cloud to run their huge, complex AI models, they just use the distributed power of millions of AI5 chips already out there in customer vehicles.
Wow, so they get massive computational power at a fraction of the cost of building giant data centers.
And it creates a whole new, high-margin revenue stream that flows directly to them, even if the car never moves.
That future revenue is exactly what's driving these wild valuation predictions. I mean, some analysts are projecting a potential $3 trillion valuation in the bull case.
But that number is entirely contingent on them dominating autonomous ride-hailing. We're talking like 70% of the global market.
Which relies on their scale approach, right? The ability to just flip a switch with a software update and activate millions of cars.
But that's the existential difference.
Yeah.
You compare that to Waymo's dedicated fleet model. They have, what, around 2,500 vehicles? It's a completely different game.
The market seems to believe this future is coming, but it's all riding on one massive, unproven assumption.
Yeah.
They have to close the safety validation gap.
This is the critical validation gap. This is what puts the entire $3 trillion thesis at risk right now. And we have specific, pretty sobering crash data from the Austin Robotaxi fleet.
Okay, what does the data say?
Those pilot vehicles are currently crashing approximately once every 40,000 miles.
40,000 miles. I need some context for that number. How bad is that compared to an average human driver?
Well, the average, distracted U.S. human driver crashes once every 500,000 miles.
Half a million.
So think about that. Tesla's robotaxis are currently crashing 12 times more frequently per mile than an average person. And crucially, all those crashes happen with a safety monitor in the car. The AI couldn't be trusted alone.
12 times more frequently is not a gap, that's a chasm. What's the problem? Is it just a data issue, or is it something more fundamental about the AI's ability to reason?
Most of the research points to a fundamental reasoning gap. It's not a sensor problem. It's an execution problem in unpredictable situations, what engineers call edge cases.
Situations it wasn't trained on.
Exactly. And if the AI5 chip, for all its power, can't bridge that reasoning gap to get demonstrably safer than a human, the entire autonomous bull case just collapses.
The risk is crystal clear. It's almost binary. But let's look at the resources they have, talk about the Q3 financials, because that balance sheet is undeniably a fortress.
The financial fortification is their core advantage. While legacy auto is trying to protect margins, Tesla generated a record free cash flow of nearly $4.0 billion
in a single quarter.
in Q3 2025 alone. And that cash flow feeds the war chest. They're holding a cash and investments fortress of over $41.6 billion.
And that liquidity isn't just sitting there.
No, it's actively funding the immense capital expenditures for these AI initiatives, for the robotics push, everything slated for 2026.
It's a huge fortress, absolutely. But you see someone like Ford focusing on buybacks and dividends. Is this cash hoarding justifiable, or should Tesla be returning it to shareholders instead of betting on long shots like Optimus?
It's only justifiable if you buy into the thesis. If you believe Tesla is an AI company, not a car company, then that cash isn't hoarded. It's the fuel you need to decouple from the auto industry. You can't build custom AI chips or a robotic supply chain without that kind of capital.
Which brings us to Optimus, the humanoid robot.
Right. Which management sees as the potential biggest product of all time. They've called it an infinite money glitch, designed to decouple economic output from human labor.
How does a robot translate to infinite money, though?
It removes the ceiling that human labor puts on growth. If you can automate every repetitive, dangerous task in a factory or a warehouse with a general-purpose robot, you unlock exponential productivity. You can run 204/7. You can lease or sell these robots to literally every industry on the planet.
The potential market is, well, basically unlimited.
And their scale target reflects that. They're aiming to produce 1 million Optimus units a year.
1 million? Can they even manufacture that many complex machines? What about the supply chain?
That is the major logistical challenge, and they admit it. The supply chain for the high-precision parts. The actuators, the motors, the hands, it doesn't exist right now. They have to build it from the ground up.
So another massive capital
A
investment.
huge one. But while that high-risk bet is happening, you've got their other pillars providing stability. The energy storage division is really thriving.
Right. Record profits in Q3.
Absolutely. Driven by the Megapack.
Yeah.
And now they're building on that with a new product.
Tell us about Megablock.
Megablock is their new industrial offering. It's a pre-engineered medium voltage battery solution. It's targeting the huge market for grid stabilization and powering all these new data centers. Production starts at their mega factory in Houston in 2026.
So energy is becoming a mature, major profit center that can actually help fund the riskier AI bets.
That's the plan.
Okay, shifting gears. Let's revisit this legacy retreat. We now have concrete dollar figures on their pullback, and it shows the real scale of this divergence.
Ford is the perfect example. They announced a massive $19.5 billion in special charges directly related to pulling back on their all-electric vehicle investments.
$19.5 billion. That includes, what was it, $8.5 billion in asset write-downs?
That's right, writing down projects that they now see as economically unviable. It is a fundamental multi-billion-dollar pivot. They're canceling pure EV programs like the electric F-150 Lightning.
A vehicle that was supposed to be their flagship EV.
It was. And now they're shifting aggressively back to hybrids and extended-range electric vehicles, or ERVs. They're following customer demand. It's a smart cash preservation move, really. It lets them use their existing high-margin combustion engine tech.
And their rhetoric is all defensive. I saw their CEO is collaborating with Renault on cheap European EVs, calling the competition with Chinese rivals a fight for our lives.
That is not the language of growth. That is survival mode. And just like Tesla, they're repurposing assets, but in the opposite direction. Ford is turning its battery plants into a stationary energy storage business.
So they're retreating from the EV growth story to compete directly with Tesla Energy on the more stable infrastructure side.
Exactly, targeting 20 gigawatt capacity by 2027.
So given this massive industry-wide pullback, you see this strange market share anomaly. Tesla's U.S. EV market share actually rose to 57% in November 2025, even though their own sales were falling.
It's a bizarre situation. It happened because competitors like GM and Stellantis cut their EV production plans even faster. They retreated so hard that Tesla just consolidated the shrinking market by default.
Yeah.
They became the last man standing.
It's market consolidation, not organic growth.
Precisely.
Which brings us back to the core question. Is this high-risk, all-in bet on intelligence density, on the AI and software future? Is it enough to justify the massive valuation premium over legacy automakers who are just focused on steady cash flow and hybrids?
I think the best analogy for this divergence is the mobile phone industry around 2007. Legacy auto, so Ford, is acting like Nokia or BlackBerry.
They're focused on making their existing proven technology, the hybrids, the infrastructure, just more profitable.
It's a safer, cash flow positive move.
Right.
But it's strategically limited.
And Tesla's trying to be Apple.
Exactly. They are betting everything that the car is just a hardware container for a revolutionary high-margin software platform. Autonomy, FSD. They're betting on owning the operating system of transportation.
Which, of course, brings us back to that ultimate binary risk. If the AI5 chip can't close that reasoning gap, if it can't validate unsupervised safety, that's far better than a human.
If they're still stuck, being 12 times worse.
Then Tesla is left as just a high-cost hardware manufacturer with aging models, facing intense competition, and stuck with a ton of specialized chips they can't sell to anyone else.
Which leaves an important question for you to think about. We know the $3 trillion bull case relies on solving that safety gap to unlock Robotaxi revenue. But what if Tesla's AI succeeds only partially? Let's say it becomes 5 times safer than a human, which is still incredible, but not 10 times. Does the advantage of having millions of data collecting cars still guarantee them a near monopoly, or does partial success just lead to intense, profitable, but not monopolistic competition?
Yeah.
Risk defined, portfolio protected.